Good morning, ladies and gentlemen. I'm sorry I wasn't able to do a video last week. I really felt very ill. I'm fully recovered now, and so I want to concentrate on what happened this week and the past week, and really give you a prognosis which is ultimately not bullish, but in the short term very bullish indeed for equities. What we had was basically a return to, if we look at the scores which were posted in the past few days, we just had a very mild period of risk off. All that happened is that the prices returned to the moving averages for support and straight back up to 89. This is a very bullish indeed scenario for equities, and I have no doubt at all that we achieve 4,000 in the next few days. In the next couple of weeks, let's say, and probably a real blow-off past 4,000. It's beginning to look more and more like we will have a complete blow-off top in the ITOT-IGOV ratio, which we shall look at later. What is happening in bonds is very disconcerting and actually very, very interesting. We are basically going back to 2015, 2016. This is 2s10s, and you can see that every time we have blown through this 95, 96 level, we have gone quite a bit higher to 125 basis points. 2s10s at 125 basis points is very disconcerting to me. What is it saying? It's saying the Fed is suppressing the 2-year note, and everything else, the whole yield curve, is steepening out of sight. And if we get back to 125, 126 basis points, that will be the market basically going on a buyer's strike. It's very, very expensive to carry 125 basis points of negative carry. Why people would do it? Only one reason: they don't want to be in bonds as an asset class. They fear something. And that is what we shall examine by looking at the rest of the yield curve. There is definite fear in bonds. Even if we look at something as innocuous as 5s10s, you can see that it's just steepening out of sight. If 5s10s are steepening to this level around 74, that is a very, very big indicator. But if we look at the much more important 5s30s, and then this is now a weekly chart of 5s30s, we can see that just like in 2s10s, we're back to the 2015, 2016 time period. This is very disconcerting. It either holds here or it goes a hell of a lot further. A lot further. Down to these levels. Okay, this is 235 basis points in 5s10s. This is a massacre. 235 basis points, that would give us yields well above 2.5% or around 2.5% in 30-year. I don't know what to call that, but real fear. And if the Fed is definitely suppressing the 2-year note, there is liquidity sloshing around like crazy, and everyone's saying, well, we're not going to go anywhere for at least a couple of years. But people are really afraid of inflation. They're really afraid of something really bad happening, and there is a buyer strike. They don't want to be left holding duration. And that, to me, is basically the death knell of equity valuations at some stage. We need to get there before that happens in equities. But this is the warning sign. This is what I was afraid of, that this 150 area, 150 140 to 150 area does not hold it, it does not look like it will. It might get very whippy, very nasty for a couple of weeks or even a couple of months, but I'm beginning to have no doubt that we're going down here. 238 basis points. That is a long way. That is a very big move in bonds, and that has to have an impact on equities eventually. This is a chart of 10s, 30s. Now, you'll probably agree with me that we have no idea what inflation is going to be even next year. What do we know about the period between 10 years from now and 30 years from now? Absolutely nothing. But the fact that the yield curve is steepening so much, even in a part of the curve like 10s, 30s, tells me that there is basically a bias strike for duration. If we now go through this 85 basis points area, you can see that the next real support is not until 120. That's another 35 basis points of steepening. We haven't been there since basically 2011 to 2013 time frame, and before that we can go back as far back as you like. We really haven't seen it until basically 03, 04. And you remember what the stock market did between 2000 and 2003. And if we go back even further, we really didn't see it until 1993. Okay, and we all remember the really nasty trading conditions that we had in 92, 93 in equities, when things were really moving huge. And before that, we didn't have it at all in the 80s, and we really didn't have it at all even in the 70s. The yield curve was always flatter in that part of the curve, even during the 70s and the massive inflation. So to me, this is very, very important. If we go back, if we start breaking now this 84, 85 area, we are massively going down to 120. It's going to be very, very nasty and very, very quick. What does it all mean? It can only mean a bias strike for duration. If we look at the yield chart of the 30-year Treasury bond, you can see that we have basically broken the 190 level, and will we have some nasty reversals back down towards 190? Most probably, but I think the path of least resistance looks like getting up to 237 basis points. That is a big move. That is effectively a massive tightening of financial conditions. Will the stock market suffer? Yes, it'll suffer when we get there. But in the meantime, probably it's an indication that more money will flow out of bonds and into equities. I've been saying for a long time that the way the spreads are positioned is equities followed by gold followed by bonds, i.e. bonds last, and bonds is what nobody wants to hold. Well, this could very well be an acceleration of that trend, and people just dumping long-term bonds until we get to 237 basis points, and then the whole thing reverses. But that is, for whenever that happens. In the meantime, dumping equities, I think, is it's the wrong thing to do, because first of all, the move has to happen, and then the consequences. But this is a massive warning sign to me, massive warning that we are in a bias strike type of period when duration is avoided, and we just go. We have very big moves in volatility in bonds, my target now is 237 basis points for the 30-year note, and that actually matches very nicely with the TLT chart. You can see that every time it's gone below 148.90 or couldn't break 148.90, we basically very, very quickly came back to 137. And that is what I think is going to happen. This is a weekly chart. You can see the Bollinger Bands are opening up. I think it's going to take 2-3 weeks of trading around here, and then we dump down to 137. That is a massive move. That is basically going back to where we were in April and to July of 2019. It's going to be pretty nasty, I think. I think volatility in bonds, the MOVE index, is likely to move much higher over the course of the next 3 to 6 weeks. The same steepening trend is actually evident in Europe as well. This is the 5-year, the bubble. It's holding very well, this minus 68, 69 area. I have no doubt that at some stage they push it through, but really this minus 61 area is going to be very, very tough to break. It's going to make a nice little inverse head and shoulders, and at some stage we're going to break higher, but it's much slower than basically the Bund. I think the Bund has an appointment here with minus 39, minus 38 basis points. It's going to happen for sure. I'm quite positive. That is 75, 80 ticks below where we closed on Friday, and that is going to be very, very good support. But it's a trend. I'm just showing you this chart because it's a trend that's happening around the world. Even Europe, with its massive QE, is it just cannot withstand this huge steepening that is happening. Now, what I'm actually saying is that there are some bonds which are good and where duration is bid, and that is in emerging markets. So that is why I think the emerging markets to SPY trade is really going to start working, because yields in the States are going to start going higher and higher, and actually people are going to be switching their duration from US bonds into emerging market bonds. And I think that is interesting, and I think that that gives us an opportunity in equities. I think EEM is going to outperform and continue outperforming. This to me says that at some stage we break and we go and fill this gap at the very least. The tendency to steepen the curves is everywhere, seems to be very well set in motion. What is actually must be very disappointing for dollar bulls is the fact that this massive steepening in the US, this outperformance in terms of higher yields in the US against Europe and especially Asia and emerging markets, is not being reflected in any kind of dollar strength. Now, I've been saying for a long time that I think that the only way they can keep the bond markets from going berserk, and they are beginning to go berserk, is by having a cheaper dollar and therefore offering a discount on the currency to people to invest in US dollar assets. I think that will continue. I just don't see that the dollar can get much stronger than, say, 92.62 to 93.14 area. But even that, I question whether we can achieve. The dollar is weak for a reason, and I think the odds are, as it makes these very shallow corrections on the weeklies, and you see we closed exactly 91.01, And let's say that it does another leg higher. These are all legs that take it no higher than the mid 92s. You're looking for 1.5% higher, and you probably have a 5% downside risk. I think holding dollars is not, the risk reward just isn't there. I'd much prefer to play it from the downside every time it gets to an interesting level. The first interesting level could be here, 91.75. We haven't reached it. I think if we see 91.75, I start doing some put spreads or call spreads on Euro USD or the yen. I think the Asian currencies are going to be much, they're the ones which haven't done the QE, which are not printing money. I think those emerging market currencies, or, sort of not emerging market, but developed market currencies in Asia without this massive QE are going to be favored over the course of the next few weeks and months. I have no doubt that eventually the dollar breaks down and comes down to 84.50 or so. What does all this mean for gold? Well, gold is the second asset by performance stuck between equities and bonds. Equities are going up, bonds are going down, the dollar is going sideways, and gold basically as a derivative, a second derivative of bonds and the dollar is stuck in the middle and is going nowhere to down. I am now changing my mind. I don't think 1765 is going to hold it anymore because I'm so bearish on those bonds. And I think it's more likely to do 1, 2, 3, 1, 2, and then boom, down, somewhere around the 1700 area. If we have a look at it on a daily basis, what I'm saying is to avoid it. I just don't see any reason to be bullish of it because unless bonds help it along, I just can't, if real yields are rising so steeply, I really can't see that gold is going to be an asset that is worth speculating in, i.e. for a longer term rise. I think you're going to get much better levels on a daily basis. I think 1765 at some stage over the next 2-3 weeks probably gives way with 1658 as the next support. Gold is going to do better than bonds, but if bonds are going to get such a shellacking, gold is not going to hold up. Especially unless the US dollar helps it hugely. And as I've just shown you, chances are that the US dollar stays, range bound for the next few weeks, and only eventually once bonds have done what they're going to do, and the differential has got as wide as it's going to get, then it's going to start coming down. To me, buying gold even off 1764, 1765 is pointless. You might make $20-30, you might lose 100. It's a game not worth playing, and that is really what the technicals are showing you. The 200-day moving average is rolling over. We are below it. It's a game, it's a game. You might make $10, $20, $30 trading on the upside, but the risk reward just basically is not there. Not until lower levels, not until, the low 1600s, the low 1700s, the mid 1600s. Those are the kind of levels that really gold is worth playing at. Before that, you just leave it alone. Not to belabor the point, but you can see what SPY IF and SPY TLT are doing. New highs. I mean, there's every time this correction the week before last, came back nicely. Boom. This is the correction the week before last. just came down to the moving average, boom. It's just, this is a daily chart and this is a weekly chart. I like to see this on a weekly basis and this on a daily basis. Is just my perversion. It's just relentless. I think you're going to get more of it. I think it's going to go probably an order of magnitude another 10%. And it really is a flight out of anything which is fixed income into into equities. No doubt that this will continue for quite some time. You saw the absolute levels in bonds. They're 30, 40 basis points away. Money is going to keep on flowing out of fixed income and into equities for some time to come. This is a chart of TLT against gold. As you can see, it's threatening to break these very important levels that have held it for best parts of 6 months since it collapsed. The ratio collapsed, and that was the warning that bonds were the worst asset and gold the middle asset and equities the best. This now threatens to go below 80 down to 78 to these support levels. That is what, a 10% move? So it really is, bonds are very, very offered and will continue to be offered. I think you're just about to see the worst performance of bonds in a single quarter since I can remember. What is interesting to note, especially compare and contrast to to what is happening to bonds and gold, is this ratio between SPY and DBC, commodities. It's not looking very bullish, okay? In fact, it's looking like it might come back a little bit, another 10%. That is just saying that commodities are doing very well, not on a multi-year level, but on a shorter term basis. It looks like commodities are going to have a very good bid, and that is going to exacerbate the trend, the flight out of long duration bonds. It's going to keep gold in no man's land, and really people are going to be buying commodities and equities. Looking at what is likely to happen short term in the equities over the period of next week, well, as long as it's above 38.26, you just cannot be bearish of it. I mean, there is absolutely no point. And really, you can only be bearish of it if it breaks 36.46. Okay, so only under there can you really say, yes, we're bearish. And above 38.26, you can't say anything but we're bullish. And to me, you probably have 2 or 3 days of little sideways action, but at some stage we just break higher. I think there's going to be a wall of money at some stage, leaving bonds, i.e. the late people, leaving bonds, leaving gold, leaving this, leaving that, and going into basically commodities and equities. And we are just going to accelerate higher. This could be the start of the bubble, but also the booking of the funeral, as I've entitled this, because the only thing that can kill a bull market in equities is a bear market in bonds. And once we get to a yield which is way past the dividend yield of equities, that is when people actually will start abandoning equities and looking at fixed income. It's a long way away, but the funeral is booked. I keep on talking a bit about emerging markets, and that is because they are really beginning to look better. This is against Japan, this is against Germany, and this is against SPY. Rounding bottom, we do still need to take out the very long-term moving average, so it's going to take some time. But there is no doubt that we are in a bull market emerging markets against Germany and against Japan. And Japan is hardly doing badly, and Germany is doing, nothing much. To me, this says that it fits together with the bond yields higher narrative, and the markets that have lived all their lives with much higher bond yields are actually going to be able to cope with them much better than the markets which are addicted to low bond yields, like Japan, Germany, and the US. To me, being long of emerging markets rather than these developed markets makes a hell of a lot of macro sense. The one piece of the puzzle which doesn't quite fit, but not all pieces have to fit, is what the tech market sector is doing, and it is actually appreciating against everything else. This is against XLF, XLK. You would have thought it would be higher. XLV, XLK, you definitely would have thought it'd be higher. XLI, XLK, well, that is, less certain. But certainly the fact that IWM is beating QQQ, and while the Qs are beating SPY, that is a bit odd. But what would explain it is the fact that we are going to have a massive blow-off top. And I'm beginning to more and more think that is beginning to be likely, that people are just going to be buying equities for growth and just abandoning bonds as and that would be a massive flow, and that would cause that 25, 35 basis point move in bonds. That people are just going to throw in the towel and say, bond duration, who needs it? I want to have as much growth potential as possible. Buying small stocks, buying anything that has a long runway like tech stocks, or especially smaller tech stocks. We could see a real acceleration here, even though the yield curve is steepening. You have to respect what the market is saying. The market is saying that the odds of a real move in equities higher over the course of the next couple of months, i.e. a 10% blow-off top, are actually increasing rather than decreasing. And all that I've been saying brings us back to VIX. What do I think about VIX? You saw 2 weeks ago how VIX was by far the best hedge against a long equity position. And that is why I'm so happy to be long of calls on equities rather than be long of the outrights. That's because it gives me both a long volatility position and a long equity position. I think that at some stage volatility is just going to explode. And when I say explode, I think back to the 80s. I don't know whether that is going to be after we've had the blow-off top or during the blow-off top. I'm increasingly beginning to believe that we're going to get a blow-off top. But to me, the best position to hold is one of long emerging markets and long of cheap volatility, like in Europe, or maybe less so in the States. That is from the fundamental point of view, that makes a huge amount of sense. Emerging markets are outperforming and should continue to outperform and should be the least susceptible to higher rates. And finally, volatility, I think, is going to make a comeback in a big way. I think 2021 could be the year that we see record levels of volatility. I don't know what's going to cause them. I just have this feeling that the best hedge against what is about to happen in yields and in equities is to have some volatility on board. It's not going to happen next week or the week after, most probably, but at some stage, volatility is just going to fly because, we are in a very, very unbalanced position. And things will tend to get much more unbalanced before they go back to where they, to levels that make sense. I think any time the volatility gets into the 20 or into the low teens, it's a no-brainer to buy 3 to 6 month calls on it. And so on to the recap sheet. 2 stands, 530s, I think the Fed is losing control. They have to do something because if it goes through 154, I showed you that chart of the bonds. It's going to go 30 basis points quite quickly. And that is going to be a massive shock to the market. DXY, I can't get bullish of it. I can just get neutral of it. But you saw that every time it pokes its head up to 91.01, it comes back to 91.01. 92.62 I would love to see, but really I think realistically 91.75 is the best you can hope to see and the level to start looking to buy some put spreads on DXY or call spreads on currencies. Gold, I'm much less certain now because of what the bonds are doing, that 1765 will hold it. I would have thought 1705 is, if we see it next week, is a very reasonable level to, to buy it for a $50, $60, $70 run up. Anything around 1870 and 1880, I would really buy some puts. I think that's much more likely to go down from that level than anything else. Now, SPX, as long as it's above 38.25, it's immediately bullish. It's just all there is to it. It's holding the red in deviations. It might go sideways for a few days, but then I think there's no doubt that 4K trades in an acceleration as the bonds come down. And as money leaves bonds, it has to go somewhere, and really it'll go into SPX and drive it higher. NQ, as you see, it's not underperforming seriously. I think 13,200, as long as it's above there, it's immediately bullish, much like with SPX 38.25. The weekly Bollingers are 13,900, but I'm telling you, when that acceleration starts taking place, you can forget about the weekly Bollingers, the monthly Bollingers, and any other technical indicator. The wall of money, when you think how much money is in bonds, trillions, you are really beginning to see an acceleration in everything, completely unsustainable, but an acceleration that at some stage will be undone, but while it lasts, it's going to be spectacular. EEM, 58, 5208 support, will it get there? I don't think so. Where's resistance? Well, I don't think there really is any. Having broken a multi-decade rounding bottom, I think we have a long way to go. 20-30%, that kind of outperformance. It would not surprise me to see it at 75, 80 in this year, 2021. Nikkei is still interesting because it fits in with the EEM. It has not traded below 25.6. It's going to 30K probably in the next couple of weeks. TLT, I think violent moves are going to start happening both ways now. We will have some fantastic squeezes in the bonds, I'm absolutely sure, and that target will be, to me now, 137 over the course of the next couple of months. VIX is going to be, to me, the most interesting trade this year, and long-term accumulation every time it falls below 20. I will now do a video about the bond position and explain to you what the alternatives are and post it separately. In any case, tweet you on Monday. Thank you very much indeed, and speak to you later.